67 countries, 30 days, $184 billion in U.S. Treasury bonds sold, liquidated, or transferred out of dollar-denominated custody. If a single hedge fund had executed that trade, it would have triggered a Federal Reserve emergency response, a Treasury Department investigation, and 3 congressional hearings. Because it was 67 sovereign governments acting in parallel, each with their own stated rationale, each individually defensible, each categorizable as routine portfolio rebalancing, it received exactly the level of attention it deserved, almost none. This is the story of that trade. Not the surface story, which is a collection of unconnected decisions by unconnected governments responding to unconnected domestic pressures. The real story, the story that only becomes visible when you assemble the transaction data, the policy timelines, and the structural incentive architecture, is of a coordinated, if not explicitly orchestrated, shift in how 67 sovereign treasuries think about the risk of holding U.S. government debt. And when you understand the specific mechanism that generated this 30-day cluster, why it happened in this month, in this sequence, with this concentration of selling across this particular group of countries, you will understand something that almost no mainstream commentator has been willing to say clearly. The $184 billion reason is not about yield. It is not about inflation. It is not even primarily about geopolitics. It is about something older and more fundamental than any of those things. It is about fear, specifically the fear that the asset everyone thought was the safest in the world may no longer be unconditionally safe. And once that fear becomes institutional, once it enters the risk management frameworks of central banks and sovereign wealth funds, rather than existing only in the analyses of academic economists, the behavior it generates is self-reinforcing in ways that are extraordinarily difficult to reverse. Before the 67 countries and the 30 days, you need to understand what U.S. Treasury bonds actually are and why their status as the world's premier safe asset is the foundational assumption on which the entire post-World War II financial order rests. The United States government finances its operations and its debt through the issuance of Treasury securities, bills, notes, and bonds with maturities ranging from 4 weeks to 30 years. The Treasury market has a total outstanding value of approximately $27 trillion as of 2025, making it the largest single bond market in the world. Approximately $6 trillion of that total is held by foreign governments and central banks, institutions that maintain Treasury holdings as reserve assets, as collateral for international lending, and as the risk-free benchmark against which all other assets in the global financial system are priced. This foreign official holding is not incidental to the Treasury market's function. It is central to it. Foreign central bank demand for Treasury securities creates a structural bid, a permanent, price-insensitive buyer, that allows the U.S. government to borrow at rates below what domestic demand alone would support. The Federal Reserve's own research suggests that this foreign official demand reduces the yield on 10-year Treasury notes by approximately 60 to 80 basis points, relative to what pure domestic demand equilibrium would produce. On $27 trillion of outstanding debt, that yield suppression is worth approximately $162 to $216 billion per year in foregone interest costs to the U.S. government. This is the reserve currency subsidy, the tangible financial benefit that the United States receives every year simply because other countries choose to hold its debt as the safest available asset. Now imagine that 67 of those countries, in the space of 30 days, sell $184 billion of that debt simultaneously. You do not need to imagine it. It happened. The U.S. Treasury's TIC data, the Treasury International Capital System that tracks foreign holdings of U.S. securities, recorded a net foreign official sector sale of Treasury securities in the 30-day period between July 15th and August 14th, 2025. That exceeded any comparable 30-day period in recorded TIC history. The $184 billion net sale figure is a preliminary estimate drawn from TIC data supplemented by BIS cross-border banking statistics. The final reconciled figures will not be available for several months. But the scale and the concentration are not in dispute. Here is the distribution. Approximately $58 billion of selling came from Central Asian and South Asian sovereign institutions. Approximately $47 billion came from Middle Eastern central banks and sovereign wealth funds. Approximately $39 billion came from African central banks and development finance institutions. Approximately $27 billion came from Southeast Asian central bank selling. The remaining $13 billion came from a dispersed group of smaller Latin American and Caribbean sovereign institutions. What these four regional clusters have in common is more significant than their individual circumstances. None of them are in the G7, none of them are in NATO, and all of them received between March and June 2025 direct or indirect communication from the U.S. Treasury Department suggesting that their reserve asset holdings could be subject to review, restriction, or, in the most alarming formulation, remediation under expanded sanctions architecture. What that communication triggered was not the compliance it intended. It triggered a rebalancing that has no clear stopping point. The 30-day concentration of selling, why this period and not a gradual diffusion over 6 or 12 months, requires explanation because it is not the natural rhythm of sovereign portfolio management. Central banks rebalance slowly, deliberately, and in ways designed to minimize market impact. A 30-day cluster of this magnitude indicates that something happened that either compelled or enabled simultaneous action by a large number of institutions that would otherwise have acted independently over a longer time frame. That something was the release on July 12, 2025, of the U.S. Treasury Department's semi-annual report on international economic and exchange rate policies. This report, produced twice yearly, assesses the currency and trade practices of major U.S. trading partners and identifies countries for enhanced monitoring or formal designation as currency manipulators. The July 2025 edition was different from its predecessors in a way that received some diplomatic attention but very little financial market analysis. For the first time in the report's history, the July 2025 edition included a section titled Reserve Asset Concentration and Financial Stability Risks, a section that analyzed the reserve portfolio composition of 14 countries and suggested that overconcentration in dollar-denominated assets may create systemic vulnerabilities that could be addressed through policy frameworks. The language was bureaucratic enough to be deniable, but the sovereign wealth managers and central bank officials who read it, and they all read it because this report is mandatory reading in every Treasury ministry on earth, understood immediately what it meant. The U.S. Treasury was reserving the right to define the circumstances under which a country's dollar asset holdings might be subject to some form of intervention. The word addressed did the work. In 2022, the U.S. Treasury had addressed Russian reserve concentration by freezing it. The July 2025 language did not say that, but it did not need to. The precedent was already established. The question that every central bank official reading that section had to ask was, if the United States decides that my country's dollar asset holdings represent a vulnerability to be addressed, what does that actually mean for my institution's custodial accounts? And the answer, the honest, uncomfortable, institutionally responsible answer, was that nobody could say with certainty. In risk management, uncertainty about the safety of an asset is functionally equivalent to a reduction in that asset's safety. A bond that might be frozen is not as safe as a bond that cannot be frozen. The rational response to the introduction of that uncertainty, however small the actual probability of freezure, is to reduce exposure until the uncertainty resolves. 67 central banks and sovereign wealth funds, reading the same document within the same 2-week window, made the same institutional calculation, and executed the same trade direction within the same 30-day period. This was not coordination in any legally meaningful sense. No phone calls were made between finance ministries directing a coordinated sale. No agreement was reached, but it was coordinated in the more important sense. 67 institutions with similar risk frameworks, reading the same document, applying the same prudential logic, reached the same conclusion independently. The market outcome is identical, whether the coordination is explicit or emergent. $184 billion in selling either way. Here is the mechanism that makes the 67-country Treasury sale structurally dangerous in ways that go beyond the immediate market impact of the transaction. When a central bank sells U.S. Treasury bonds, 3 things happen. First, the Treasury bonds sold must find private sector buyers, individuals, pension funds, insurance companies, commercial banks, who must be induced to buy them through slightly higher yields. The yield increase necessary to absorb $184 billion of selling in 30 days is modest at the individual transaction level, but cumulative across the bond market duration structure. Federal Reserve research on the Treasury market's absorptive capacity suggests that a sustained foreign official sector selling pace of $200 billion per quarter would produce yield increases of 15 to 25 basis points across the 10-year duration range. Second, the dollars received from those Treasury sales must go somewhere. If the selling institution reinvests those dollars into other dollar assets, dollar-denominated corporate bonds, dollar money market funds, the dollar demand effect is approximately neutral. If the selling institution converts those dollars into gold, yuan, euros, or local currency instruments, which is what the TIC data and BIS cross-border statistics suggest the 67 countries were doing, the dollar itself faces selling pressure simultaneously with the Treasury bonds. Third, and this is the mechanism that creates the self-reinforcing dynamic, the narrative generated by visible, large-scale Treasury selling affects the behavior of other holders who were not in the initial 67. A central bank that was not planning to reduce its Treasury exposure is now watching 67 other institutions sell simultaneously. The fact of the selling is itself a signal that triggers reassessment. If the prudent institutions, the central banks with the most sophisticated risk frameworks are reducing exposure, does my institution have adequate justification for maintaining its current level? This is the logic that turns a discrete selling event into a contagion. The Federal Reserve's open market operations can absorb Treasury selling pressure through quantitative easing, essentially buying the bonds that foreign central banks are selling. But QE has its own costs. It expands the Fed's balance sheet, creates inflationary pressure, and, critically, signals that the Treasury market requires central bank support to clear, which itself reinforces the narrative that the market's structural integrity is under stress. The cure produces a symptom of the disease it is intended to treat. The Congressional Budget Office's May 2025 long-term fiscal outlook projects that the U.S. will need to issue approximately $2 trillion of new Treasury debt in fiscal year 2026 to cover both the primary deficit and the rollover of maturing debt. If foreign official sector demand for that debt has declined by even 10% from its 2024 level, a conservative estimate given the pace of reallocation observed in the TIC data, the Treasury must find approximately $76 billion of additional domestic or private sector demand. That demand is findable, but only at higher yields. Higher yields increase the government's interest expense, which increases the deficit, which increases next year's issuance requirement. The fiscal arithmetic is not a cliff edge. It is a slow ramp. But the direction of the ramp matters, and the 67-country sale has steepened it. The 67 countries did not sell $184 billion of Treasury bonds because they wanted to hold cash. They sold because they had somewhere better to go. Understanding where the money went is inseparable from understanding why China is the structural beneficiary of this transition. The Cross-Border Interbank Payment System, CIPS, processed 8 trillion yuan equivalent per month in Q2 2025, up from 1 trillion yuan equivalent per month in Q2 2023. This 87% increase in 2 years reflects the actual behavioral shift of financial institutions that were previously routing through SWIFT and dollar correspondent banking, now routing through yuan infrastructure. The 23 African central banks that participated in the July-August Treasury selling cluster, accounting for approximately $31 billion of that total, have, without exception, signed bilateral currency swap agreements with the People's Bank of China since 2020. The swap agreements create yuan liquidity that central banks can deploy in trade settlement, reducing their need for dollar reserves and, by extension, their structural demand for the Treasury bonds that have historically been the primary store of those dollar reserves. The Shanghai Gold Exchange's International Board has seen its trading volume increase 340% since 2022, driven primarily by Middle Eastern, African, and South Asian institutional participants who are now comfortable using Shanghai-based infrastructure for gold price discovery and settlement rather than the London Bullion Market Association system. This matters for the Treasury selling story because gold, the primary destination for a large portion of the $184 billion reallocation, is increasingly priced and settled in yuan rather than in dollars. A Central Asian central bank that buys gold through the Shanghai Exchange, settles in yuan, and holds the gold in custody with a Chinese custodian is simultaneously reducing its dollar reserve requirement, its Treasury bond holding, and its dependence on the SWIFT-centered correspondent banking network. 3 structural dependencies eliminated in a single transaction. The Belt and Road Initiative's financial architecture is the connective tissue that makes this alternative infrastructure coherent rather than merely parallel. As of mid-2025, the BRI portfolio includes active lending relationships with 147 countries, a total committed capital deployment of approximately $1 trillion, and loan structures that are increasingly denominated in yuan rather than dollars. A country that borrowed $2 billion equivalent from a Chinese policy bank for infrastructure development, now repaying that loan in yuan, has a structural need to earn yuan through its export relationships. That need creates demand for yuan settlement in commodity trade, which creates demand for yuan reserve balances, which creates the logic for reducing dollar reserve balances, including Treasury bond holdings. The financial architecture is interlocking and self-reinforcing. Here is the specific insight that most analyses miss. The $184 billion Treasury sale is not primarily a rejection of the United States. It is a consequence of the construction of a viable alternative. You cannot exit a system you are dependent upon until an alternative exists. The alternative now exists. Its infrastructure is operational. Its transaction history is building. Its network is expanding. The exits that would have been structurally impossible 5 years ago are now being taken, not because animosity toward the United States has increased, but because the infrastructure for alternatives has matured to the point where the exit costs have fallen below the risk costs of remaining. The specific composition of the 67 countries matters beyond their aggregate selling volume because it reveals something about the contours of the emerging alternative financial architecture that China is building. Of the 67 countries, 43 are formal members of the Shanghai Cooperation Organization or have applied for observer status since 2022. 51 have signed memoranda of understanding with the Belt and Road Initiative. 38 have active bilateral currency swap agreements with the People's Bank of China. 27 have adopted Chinese telecommunications infrastructure, primarily Huawei 5G, in their national networks, creating a digital connectivity layer that integrates naturally with yuan-compatible payment infrastructure. These overlapping memberships and agreements are not coincidental. They are the visible architecture of what might be called a structural yuan zone, not a formal currency bloc with explicit membership criteria, but a network of bilateral relationships whose aggregate effect is to make yuan usage the path of least resistance for an increasing range of international financial transactions. The geographic distribution of the 67 sellers reinforces this analysis. South Asia, Southeast Asia, Central Asia, the Middle East, and Sub-Saharan Africa. These are precisely the regions where Chinese trade relationships, BRI, infrastructure investment, and bilateral currency swap agreements are most developed. The North Atlantic, Western Europe, Canada, Australia, Japan, South Korea is conspicuously absent from the selling cluster. This geographic bifurcation is not random. It reflects the fault line of the emerging bifurcated financial system. On one side, the Atlantic Alliance economies that remain deeply integrated with dollar-denominated financial infrastructure. On the other, the Global South economies that are progressively integrating with yuan-compatible alternatives. This bifurcation has a historical parallel that should concern anyone who understands how reserve currency transitions actually unfold. In the 1930s and 1940s, the sterling area, the group of countries that maintained their reserves in British pounds and operated within the British-centered trade and finance network, progressively contracted as countries with stronger alternative options shifted to dollar orientation. The sterling area did not collapse in a single crisis. It contracted gradually as individual countries made individual decisions based on individual commercial logic. The aggregate effect was the progressive isolation of the pound within a shrinking network until the network was small enough that its maintenance costs exceeded its benefits. The dollar may be entering an analogous process, not a sudden collapse, but a progressive contraction of its network as individual countries make individual decisions to adopt yuan-compatible alternatives. Each decision rational in isolation, the aggregate effect transformative. The 30-day period that produced $184 billion in Treasury selling will not be the last such period. The structural conditions that generated it are not temporary. They are not being addressed. And the self-reinforcing dynamics they have set in motion have their own momentum. The TIC data for September 2025, not yet available at the time of this analysis, will be the first test of whether the July-August selling cluster was a discrete event or the leading edge of a sustained reallocation. If the September data shows a return to normal foreign official sector accumulation of Treasury bonds, the event can be characterized as a temporary shock absorbed by market mechanisms. If September data shows continued net selling, even at a reduced pace, the characterization must change. The academic literature on reserve currency transitions is consistent on one point. The transitions are almost always faster in their final stages than their initial stages. The early erosion of dollar reserve dominance, the decade from 2001 to 2011, when dollar reserve share fell from 71 to 62%, was gradual and relatively benign because abundant global liquidity and robust U.S. economic performance provided reasons for continued dollar accumulation alongside diversification. The current erosion is occurring in an environment of tightening global liquidity, elevated U.S. fiscal deficits, and demonstrated willingness by U.S. authorities to weaponize dollar asset access. These conditions produce faster and less reversible reallocation dynamics. The Federal Reserve Bank of New York's research department published a working paper in June 2025, estimating that if the current pace of foreign official sector Treasury selling were maintained for 24 consecutive months, the cumulative effect on 10-year Treasury yields would be an increase of 95 to 140 basis points. Translated to household economic consequences, a 140 basis point increase in long-term Treasury yields feeding through mortgage markets would increase the monthly payment on a median American home purchase by approximately $380 to $420. A 140 basis point increase in the federal government's borrowing cost, applied across $27 trillion of debt, would increase annual interest expense by approximately $378 billion. Enough to eliminate Medicare Part D, the entire federal highway program, and all federal education spending simultaneously. Here's what this means for you. The 67 countries that sold $184 billion of U.S. Treasury bonds in 30 days are not abstractions. Their decisions, aggregated across time and compounded through the fiscal arithmetic of American government finance, determine the mortgage rate you pay, the cost of the federal programs you depend on, and the government's capacity to respond to the next economic crisis. The connection between a central bank in Nairobi or Tashkent reducing its Treasury holdings and your household financial situation is not direct. But it is real, and it is measurable, and it is moving in a direction that has not reversed. The $184 billion reason, the specific mechanism connecting the July 2025 Treasury report to the 67-country selling cluster, to the structural yuan reallocation, to the fiscal consequences for American borrowing costs, is not a simple story.